Well, let's go ahead and move on. And I'm going to turn the time over to my dear friend Kyprianos Kyprianou. Let me give you a little bit of background here. Kyprianos is the director of Smart Light Investment Training Institute, and he is really a well-traveled speaker, and he conducts a lot of seminars on portfolio management and technical analysis. He really knows his stuff, and he's been a long-time partner with MetaStock for many years, and we have a great relationship with him. So I'm very excited for his presentation today, and we'll go ahead and turn the time over to you, Kyprianos.
Okay, thank you. So hello everybody. Actually now I think you can see on the screens the seminar program. So we are gonna separate it in two sessions. The first one is something a little bit more general but very important. It's about the trends, and the second is the combination with the best oscillator. And our target for today is to increase your ability to recognize the tops and the bottoms of the markets. So normally we don't need anything else if you are a trader and if you want to trade. But trust me, we need more than this, right? So, and definitely my seminar, my webinar today will not be on how to use the MetaStock, but it's going to be a step ahead because I think you know how to use it. So if not, there are more other seminars that you can follow. So now, to make sure that we are speaking the same language, I'm going to just give a fast definition about the technical analysis. So, and actually, a little bit more scientific will be a study of market action. Market action, I mean the movements of the prices, but using charts. And the purpose is to forecast where the prices are going, right? So since we are talking about charts, definitely we are talking about MetaStock, and we have to understand how to create those charts. So let's suppose that we have a stock exchange or whatever, and we have the open, let's say at 10 o'clock, 8 o'clock, whatever. So, and we follow the prices every 1 hour, let's say. So, and then we put the dots for every hour, and we put it all the way during the day up to the last trade of the day. That's going to be the close. So using this information, as you can see, we can have one price here, one price at the highest of the day, one price at the lowest, and one at the close. So we use this information now to draw the bar charts that we use a thin line from the highest to the lowest of the day. On the left, we put the open, and on the right, we put the close. So by this way, we create the bar charts. There is another information that you may need it when you read the charts, is the color of the bars. So as you may know that the different color, so based on the close, comparing with the close of the previous day, and if it's red or whatever the color, means that the close lower than the yesterday close. So this day also is red, is slightly lower, but definitely here you can see that this close is lower than the yesterday close. And then if we change the color into blue, again the color is irrelevant. You can choose any color you want. So this close is higher than the yesterday close, that's why they are blue. If you see them all together, so this picture speaks to us saying that on this part, no need to check, but the close is higher all the way since the previous close. So, and then when it's becoming red, so then we have the close lower and lower and lower than the previous closes. So here we use another datum, which is the volume. Volume is the number of shares traded during the day, or number of contracts also. So in this case, as you can see, we have the combination of the bars and the volume, right? So if we go back, we can have another kind of charts that we call them candlesticks. The candlesticks, again, to create them actually, we need the open and the close, and we draw a box. And then a thin line up to the highest and the thin line up to the lowest shows the range of the day. So by this way now we have a new kind of chart, but unfortunately here for this kind of charting, we don't have left and right, and it's not that easy to know where is the open and where is the close. So that's why we color the body of the candlestick. So if it is colored or black or red or green, whatever, so then means that the open is higher than the close, and that means during the day we open here, we move a little bit up, we move a little bit down, and finally close at the lowest of the box, right? So this is the foreign language that I'm talking about. So as you can see here, we can have, let's say, black and white candlesticks. So, and actually we have filled by a color, like the last one, and empty, that we call them white or whatever the color is in the background. So, by this way now, we have the ABC of this language. So, and of course here I'm going to show you the difference between the bars and candles. And look at what's happening here. So we open here and we close at this point. And then we open at this point and we close for the second day, and then the third day and the fourth day. So as you can see here, the close is higher than the previous close. That's why it's blue. So in this case, if you just see the blue bars, you say that one class actually, without checking the close, so you will see that everything is fine. But if you check the same market using the candlesticks, Dave? Hello? Dave, I cannot hear you.
Yes, hi, Dave is here.
For the, yeah.
Can you hear me okay?
About you? Because Theo called me that you cannot hear.
Yes, you're coming in loud and clear.
Okay, maybe it's Theo's problem. Okay, I have my spy, you know, that is following the seminar. Okay, so let's continue. So that's the difference between the bars and candles, all right? So if you just see the bars alone, so you may think that everything is fine, but when you see the black candlestick, this means something. And we are gonna use the candlesticks because they are bigger and we have more mass to realize what is going on, right? So look at what's happening here. We have a market with the whole movement and the volume below, and we are going to combine everything today just to see how can we forecast what's going to happen. So that's why now I'm going for the real seminar, which is actually the price analysis, right? We will see the candlesticks to decide what is going on, right? So as you can see here, we have a white one, that means an empty one. So that means the open is here, the close is higher. So, and here is the opposite. We open here and we move lower and we close here on the lower part of the box. So look at this one. So this one actually, the open and close is at the same level. We open here, we moved higher, lower, and finally close at the same level. But that was a lot of activity. And then we have here a smaller candlestick, again with the open and close at the same level. So look at this now. Let's follow this chart here, this figure, and then let's try to forecast things, right? So if we have just two candlesticks, one white and another one black, so people can name these as a dark cloud or whatever the name, you know, have fancy names for the candlesticks. But from the forecasting point of view, we cannot forecast anything because we don't have so much data. So that's why we recommend to the people to use more data in order to forecast what may happen tomorrow, right, or the next hour. So that's why we use now 5 days or 5 periods, actually. Could be weeks, days, or hours, or 10 minutes, whatever. So, and at this point, we can see that everything is positive. The market is going up to the last one that we call it doji. So by itself, the doji doesn't mean that it's gonna, that cannot help us to forecast anything. So, but if we combine it now with a black candlestick that is coming on the C day, as you can see here, so as you can see here, so then there is something to forecast. So most of the people, if that knows about candlestick, will say that we have a formation here, it's an evening doji star, and that's why the market's gonna go down. Unfortunately, since I'm a member of the IFTA and we try to help people to see what's happening on technical analysis and not to remember names, so I'm going to tell you that the reason that we can forecast the D1, and most probably will be black, so is because during this black candlestick, we have so many losers that they can destroy the psychology of the market. And because they want to get rid of the shares, they start selling aggressively. That's why we may have the next one that's going to be black one. Again, all those people that they bought during this white candlestick, and even those few that they bought at the B, now all of them have losses. So by this way, their mind now is not working properly. I can say that now we have a little bit crazy minds in the game. And also, if you know about stop losses, we have triggered the stop losses, and that's why the next one is going to be black, most probably. Again, I use this word most probably because there is nothing that is 100%, right? So, but the biggest probability now to see the market going down after the C is to see a black candlestick after the C, just because of the enough mass of losers that will push the prices down. And this is how I'm going to approach the whole thing today. So I'm talking about the human psychology. And as you can see here, maybe you can have another one. But now, as I said before, we need to have more data in the game. So having now a kind of a zoom out of this thing, I can see that before this movement, that means the movement up, creating panic here, creating the second black candlestick and maybe a third one. If I check before, maybe I can see the same pattern. So that's why what do I mean when I say use more data? I mean make a zoom out and check a little bit more data to see what's happening, because if you see that this happened again before, so you will see clearly that after the A, we had a movement up to the B that shouldn't sell anything here because actually you can make money. So by this way, if we are on the E, if you see that this is happening before, most probably we will see this happening again and we will see a higher level than the B. So what I'm saying here, there is something more than the candlesticks formations. So it's something bigger than this, is more stable, and this is the basic datum for trading. This is the trend. So that's why we need to have a clear definition about the trend. So a definition about the trend could be one top, which is the highest of this area, second top, and then we have one bottom and the second bottom, and as you can see clearly, the second top is higher than the first one, and the second bottom is higher than the previous one. So that's why we need to have successively higher tops and bottoms, and actually after the second one, the second top actually in this case, then we have the beginning of the trend. And the trend is your friend, but nobody, I mean, a few guys, they are checking exactly what kind of trend do we have. So, and I can say here that we have the uptrends, downtrends, and the ranges. Normally, in an uptrend, we have to go long. So in a downtrend, we have to short the market or sell. So, and during a trading range, it's better not to do anything, right? So in this case now, we need to understand and count the tops and the bottoms before we are going to say that we have a trend. So, and definitely a definition about the uptrend is a series of successively higher peaks and troughs, and we need at least two. For the downtrend, we need the opposite, declining peaks and troughs, at least two. When we are talking about peaks, you understand what they're talking about. So, but troughs actually are the bottoms. This is a more scientific word about the bottoms, right? So horizontal peaks and troughs are creating the sideways market that we normally do nothing. From here up to here, the movement is one way, even though we have some small candles. I'm just showing the first leg, right? So then the market went down, creating a correction up to this bottom. But now we have to define the correction. The correction is a part in the market from here, going higher. This black alone, this lonely black candlestick there, doesn't create any panic, because the next day, clearly, the buyers took the lead and then moved the price up to there. So definitely here we have panic, because we have 1, 2, 3, 4, 5 black candlesticks almost. So, and then the market up again, then panic, then the market up, then we stay in a little bit range and breaking up again. So now, if we know that we have more than 2 tops, this is the top that is higher than the previous one, and this is a bottom that's higher than this one. So we can say that above this level, we have the uptrend, and the uptrend, as Dow said, will continue forever until we are going to have definite signals that the market has already reversed. Okay? So, and what is this definite signal? We will see it in a minute. So look at this again. So I'm going to use this drawing here again to tell you that the movement starts from the all-time low, moves up, has a correction, moves higher, has a correction, moves higher, and when I draw here the white candlesticks, so I mean that the breaking is clear, right? Because sometimes you see a break that is not that convincing. So that's why I name it the healthy white candlestick is breaking up, showing the continuation of this movement. So above the B, by definition, we have the uptrend. Okay, so then we reach the C, we have another correction with panic, and then now we are approaching the C. So the C now becomes a possible resistance. A possible resistance, why possible? Because when we have the uptrend already established, most probably we are going to break the resistances, and this possible resistance is not going to be even a resistance. That means a level that is going to stop the prices going up and push the prices down, right? So, and as you can see here up to the D, we can have a correction again, and above the D, we reach the level E. So now, if you can see what is happening after the all-time high, so of course the all-time high is named afterwards, right? So after we are going to have this F. So that's why now we reach the E, we are coming down for a correction, but as you can see here, we can't go higher than the E, not even to reach the E level. So this F top that is lower than the all-time high, as soon as the market is going to move down, we name it failure swing. Failure to go higher, swinging down, breaking for first time in this uptrend a bottom. And this is our failure swing, which is the best formation to follow, making your price analysis to discover and decide what the market will do next. It's not a candlestick thing. It's a full changing of the direction. So that's why the failure swings are the ends of the uptrends. And of course, we have this on the downside. We have the downtrend established. We break all the possible supports one way. So, and then we are reaching the all-time low, and then there is a movement up that is just a correction again. So, and then a movement down, but cannot break the all-time low. So that's why in this case, when it's bouncing up, then we have our failure swing, that is the reversal of the downtrend. This is the definite signal that Dow said that is gonna change the direction of the downtrend of the uptrend. So in this case, on the next example, so I have to show you the last part of the uptrend, all right? So in that means we are on this case on the uptrend. So, and we have the candlesticks now how will be the whole setup, right? So we have the last leg of the movement. This is the all-time high. Then we have a good correction that creates panic, not just one candlestick. So I don't want to make it like 1 or 2 or 3 or 4 candlesticks. You can see it clearly that we have panic here. And then after the panic, for those that they are long or that they bought actually, so the confidence comes back again, but unfortunately, those that they are long, they are not going to see higher highs here. So the black candlesticks are coming again, creating more panic. So and then they are breaking the bottom that was created at the top. So that's the formation for the failure swing. And the failure swing is this top, the highest of this area, that is lower than the all-time high and breaking downwards. Okay, so that's why to have a nice and perfect failure swing, so we need to have at least 3, 4, and another 4, and another 4. That means we need to have 8 to 10 candlesticks at least, not just one candlestick, second here, one white, and then breaking down, and then to name it as a failure swing, because the reversal of a trend is not happening very fast. We need to have a lot of candlesticks to realize that and decide if this market will reverse in order to forecast that from now on we'll have to short the market. Okay, so look at this, the opposite side. It's a real market, this one. So the market is going up to here, the all-time low. Let me maximize the last part at least. So as you can see, this is the all-time low. The market moved up. We came down with the not that good correction, but still the market is going up. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9 candlesticks, the time that was breaking, right? So that we call this completion of the failure swing. Doesn't mean that it's finished, no, it's the beginning of the uptrend, but as a formation is completed as soon as we close above this top, right? So, and then it's coming to test it again, and then it's going up. So if you see it, and for those that are a little bit more aware about technical analysis, actually it's a head and shoulder, right? So, but we simplify the things using the failure swing, because sometimes you cannot see easily the head and shoulder, but definitely you can see the failure of going lower than the all-time low, right? So that's why we are going to use this as information to check the markets. So, and before to go to this mathematical analysis, so I want again to show you this picture. And we are going to have now a small break for 5 to 10 minutes for your questions, right? So if there is something that you didn't understand, please, you can raise your hand and then you can talk on your microphone. And by this way, we will be sure that you don't miss something, or you don't, if you want to ask something, you have to clear it now. Before I'm going to continue with the momentum oscillators, that we are going to combine them with the tops and the bottoms of the markets. Okay. So now, please feel free to ask me any question that you want up to now about the price analysis. Raise your hand. If you can see on the top, there is a guy with the hand up. So I don't know if I can show it here, but no. All right. Any questions, please? Okay, I don't see anything. That means, okay. So I'm trying to make it a little more interactive. If you want to ask me something, please feel free to do it now. Okay, I'm going to go for some examples then about the trend. We are using the MetaStock. So I'm going to start with the currencies. So in the meantime, if there is something that you want to ask, please don't hesitate. So let's open some currencies here. All right, I have here the euro yen. As you can see, we have a clear uptrend. So then we go down, and then now look like that we fail to go higher, right? So if we change it into weekly, this is a daily. If we change it into weekly, so you can see again that that was a huge movement up. So then a correction, and somewhere here, if it's going to reverse, maybe it's not going to be only a failure swing on the daily, but it's going to be a failure swing on the weekly too, which is very important. So I have to show you here the opposite. Actually, is the yen euro for those that are not aware about the opposite. Anyway, but let's see here. So this is what we are going to cover later, the blue line. So, but now we are focusing only for the price analysis. So this is the yen, the dollar yen we call it. So is the dollar against the yen. So we have a clear uptrend here. So here we have the sterling, that is the GBP against, so look at this, what's happening. So sometimes this one, you can see that we are touching the same level. We moved higher and we came back and we closed here. So that means the break was not real in this case. So some people can consider this as a double top with a bull trap here. That means they put them long and the market break down. So after this movement down, we test it again. Normally we test it again, the breakout of this bottom. So, and then all the way down in a clear downtrend. Okay. So if we are here, we have the euro sterling. So look at how complicated the thing is coming. So at this end, but look at how clear was this failure swing. Actually, we are going down all the way. And this is nothing actually, and then moving up, and then failing to go lower, and then breaking up, and then we start this uptrend. Of course, there is a small fake failure swing here, right? So, and then again up to the top. So, as you know, the euro sterling depends on the euro and the sterling movement against the dollar. So that's why this is a little bit, you have to know exactly how to trade this one. So in this case, we have the euro against the dollar, right? So you can see here we failed to go higher and then we broke down all the way, right? So here, at this point, that was the bottom of the market, correction, we moved up, expect always to come back a little bit back again to the breakout level and then up. So here, never completed the failure swing down. Okay, we don't have the completion in order to go short, just moved up, failing again, came down here. But it's enough from 128.50 to 126.50 two figures here, and then uptrend again, right? So, any questions? All right. So let me continue then. So let's go for another example on the stocks. Okay. So let's see the stock, USA stocks. So here is Starbucks, right? Okay, not nice corrections, and then that was a good one, and then breaking up again. So this is a daily. So expect also some kind of gaps on the stocks, right? Because we have a gap means we close here, and then the next open is well higher, leaving this space empty without having any candlesticks there, right? So those are called gaps. So here we have Apple, right? So you see just this small bounce up is enough to justify a failure swing, and then we go lower. And down, I think, yes, down. Okay, you see, we have a lot of examples that we fail to go lower, right? So now, I'm going to take this example, so which is Dow, and we say now, oh wow, Dow is flying, it's going for a new high. So that means we fix the economy and all this stuff, and then it's going higher. So the most important problem that I faced when I was younger, 20 years ago, so was just this frustration that when you see that the market is flying and you buy somewhere, so and then you realize later on that is the all-time high, you feel really stupid in this case. So that's why I had to discover a system, a method that is going to tell me that most probably we are approaching the top in order to stop buying, right? So actually you buy somewhere, and then you have to find somewhere to sell, and then to short if you want. But there is a level or a stage that we call it don't buy anymore, which is going to be, if this is the top or will be the top, so most probably it's going to be this stage, right? So that's why we buy somewhere. There is one level that we don't buy anymore, So, and then there is a level that we are going to sell, and then another level that's going to short. So that's why we are talking about, when I say levels, I don't mean exactly, I mean numbers or prices, but I mean stages, right? So you can buy more, but there is another level, another stage that you don't buy anymore. It's going to be another stage that you have to sell whatever you have from before, and then you can be short. Of course, I know a lot of people that they sell whatever they have, and directly they are going short here. But this is really, really not right, not correct according to the trend analysis. Okay, so let's see now how can I confirm that most probably will be the top. Okay, so I go back again to my drawings. So, and I'm gonna say again that just before the failure swing, still on the uptrend, just before the E, there is something that you can check. Very simple thing. It's gonna tell you, don't buy anymore, don't trust this movement, maybe it's the last leg of the uptrend. So, of course, if you are wrong, you buy later, right? But we say don't buy anymore, we don't say sell or short, right? So as I said before, when we are in an uptrend, we buy. When we are in a downtrend, we have to short or just sell if you don't have the short. So, but there is a stage that we don't short anymore or we don't buy anymore. Okay? So let me show you one example, one simple oscillator. So we call it oscillator because actually it's a line that is going above and below a zero line, or a line that is going to be 100% or whatever the number, or 50%, but we call it equilibrium line. Equilibrium line means that all the powers are equal. So since we are talking about the buyers and the sellers, we have the meaning in our mind that most probably will be a level that is zero, or that buyers are equal with the sellers, or something like this. I've just simplified it, it's not exactly like this. So let's continue a little bit, and let's create this oscillator that is the simplest momentum oscillator. Momentum means power, strength, right? So it's calculating the strength of the uptrend or the strength of the downtrend, right? So see how simple it is to create it. So allow me to go a little bit with you on this mathematics, and then we can take it on the charts, which is easier. You know, you don't need to make any calculations on the MetaStock. You just move it, and then you have it. So move it from the list of the oscillators, I mean. So now let's suppose that we have 1, 2, 3, 4, 5, 6, 7 days. All right. So the close, the numbers are a little bit exaggerated, but just to show you a simple calculation. So we have the 50 at this day, the 7th day. 50 is the price. Could be anything, right? $15 or whatever. So if you compare it with the close 1, 2, 3, 4, 5, 6 days ago, so then we can find, you can make a calculation. Compare means we subtract it or divide it. In this case, we are going to subtract it. So on the 7th day, which is 50, if I deduct the 30, I come up with 20. This is the rate of change for 7 periods. All right. So and then the 20 immediately is going to a new chart that has a zero line. Okay, imagine that the zero line is when the close today is the same price as the close before. So 7 periods ago. So that's why in the 7th day, the price drop is 20, right? Is the result from the subtraction of 50 minus 30, we put it here for this day. So then we move on the next day. Let's suppose that it's the same price, but now I compare the closing price with 1, 2, 3, 4, 5, 6 periods ago again. That means we have stable periods of days that we make the calculation, and we move on the right as the chart is moving, right? So now we have 50 minus 20. Even if the price is at the same level, the difference is bigger. So that's why for the 8th day, the reading of the oscillator is 30. So then we continue with the next day, and we calculate again, to make the calculation 60 minus 1, 2, 3, 4, 5, 6 minus 10, which is a big number, is 50 the difference, right? So now continue with the same way. So and then we have on this chart the oscillator, right? So the time that the prices are still at the highest or at the same level or continue higher, and this oscillator shows a weakness, this is the time that we start thinking that something is wrong with this power of the uptrend, whatever. Okay, so this is the way that we are gonna use it. So, and then I'm gonna show you the best way to use this very simple oscillator that you can have it anywhere in any chart immediately when you are checking about the trends. And I'm telling you, you are gonna save yourself from the frustration that you bought at the all-time high, trust me, or the all-time low when you are shorting. All right. So this is the case. Look at what's happening here. So we have Apple that's going up. So it looks like that the power is okay. So, and now we are going to check two main things. The first thing that we are going to check is this that we call divergence. Most of the people know this part, right? So, but let me go through it because I have to tell you something. What is the weakness of checking the divergences? So let's suppose that the prices are going up. You see the tops. We have the number 1 top, the number 3 top, and the number 5 tops. Check what's happening with the oscillator. The oscillator has this top. The second top aligns with the tops of the prices, but the next one, so the 5th top on the oscillator, is lower than the previous one. All right. So, and the prices are flying. So that's why now something is wrong here. The prices are still going higher without momentum, without power. If we say that on the 3rd top the oscillator was around, let's say 85, so the 5th top maybe is 70, whatever. So that in this case, so the tops are going down for the oscillator, and the tops are, we have higher tops actually on the prices. This is the negative divergence. So when this is happening, imagine that you have, let's say, a car that is going uphill without power. What's going to happen? So very soon it's going to come down. But this very soon is a problem with the oscillator divergences, right? So let's continue with the opposite example. Prices are going down, and the oscillator continues confirming the movement up to the 3rd, but the 4th, actually, as you can see here, the fifth bottom on the prices cannot be confirmed with the 5th bottom on the oscillator. If you remember what is a failure swing, actually it's a failure swing on the oscillator. So when this is happening, so and we cannot confirm this downward movement of the prices, there is a positive divergence. That means sometime prices will go up, right? So look at this now. Look at what's happening here. So we have a top here, and the reading of this oscillator was whatever, 20, whatever. So, but the important thing here is that this is a zero line or the equilibrium line. So in this case, if you check what's happening, let's say with the previous top, you see that the oscillator had a reading that is definitely double the reading of this top. Normally, if we go at the same level, the oscillator should reach the same level. Otherwise, there is a negative divergence. And look at what happened right after. The market actually continues slowly going up and giving us a lot of divergences of the oscillator. That's exactly the problem with the negative and positive divergences. So that's why I had to find something that is going to be a little bit more accurate than this divergence that we have it in all the books that you can read, or even on the internet if you can Google it. So look at this again. This is a stock again. So we have higher tops and the oscillator tops showing lower. Even if from the B to the C we have the same level, if the prices are going higher, it is a divergence because these numbers should be bigger, showing the power of the buyers, right? So let's go now for the rock itself, but with another kind of interpretation. So I'm gonna use now the MetaStock again. I will show you how to put it on the charts. So let's open again, let's say Dow that we opened before. Let's open them all together. All right, look at this. So normally when I open a chart, I open it with the price rock. All right, I'm gonna delete it and I'm gonna put it again. What I said, my frustration always was that not to buy. Actually, when I was buying at the top and the market then was going down, and that was a big problem, especially if you don't put your stop loss. So let's go now and find the price rock. So as you know, this is the list of the oscillators. You have a lot, really. So, and I'm going to choose now the best one. So that's why this is in alphabetical order. I go down, down, down. Remember, the rock is price rock because we have other rocks also. All right, let's go for the P, price channel, price oscillator, price rock, price rate of change. So now I've taken from the left button and I put it not inside the prices chart, but I put it on this gray area that's gonna use, that is gonna be actually a new inner window. So, and we change the periods into 7. So if you want to make it a little bit better, you just change the color into blue. This is the way that I'm doing it. So then we can make it a little bit bolder, just to see it clearly through the webinar. So, and then look at what's happening. So I zoom it out just to show you that if you check the tops of the oscillator, you will see that they are reaching at the level, especially recently, because this is the most important to see them is the last year. So you see that it's reaching a top, right? And then it's going down. So I'm going to put a line on this average top, the recent ones. Right? Average means that not exactly at the highest, but touching most of the tops, you see? So, and see what's happening, let's say, in this case. Let's start it from here anyway. So I'm going to use this line. Let's make it a little big. So I'm going to change also the red line, that is the 0 line, the horizontal line. I'm going to make it black in order not to confuse it with the average line. I'm going to make the average line also a little bit bolder. And now let's check what's happening when the rock is touching the extremes, this average extreme line, right? I'm going to use this horizontal line and then look at this. So I'm going to put it here. When the oscillator is touching the extreme, a little bit after, we have a correction. When it's touching this top, we have a correction. So this one, this top now on the prices doesn't necessarily to be aligned with the top of the oscillator, but I check exactly the opposite. So I check if the rock is touching the extreme, what's happening afterwards, right? So look at this. This is the one that we can say that used a little bit more days before to reverse, all right? That's the one that is not 100% as I told. So then I'm going to use another one. It's a fake one, let's say. So at this top, definitely we had this movement, and look at this, after we had the failure swing and then the downtrend, all right? So then I'm going to check also this one. This top here, that's another fake one, right? But then lead to the correction. So here, again, around here, the market moved higher. And now we are at this point, right? Now the probability says that if we have 1, 2, 3, 4, or let's say 5 or whatever, 6, and if I go back again, so that was a top. That means most probably this approach. That means when the rock is touching the average line, that we can call it, let's say, that's the speed limit. So then most of the times is coming correction. I don't say that's going to be definitely a failure swing, but definitely stops you for buying more. That means if you have the tendency now or the feeling that, oh, the euro, oh, sorry, the Dow is flying and it's going to go higher and I missed it and I lost profits and so on. Actually, when the rock is touching the extreme line up, don't do it now. Most probably will be a correction. And I'm saying again, as a disclaimer from the beginning, doesn't mean that go now and short the Dow, right? So this is the approach that I want you to see and check by yourselves. So, and check actually the average line, the average extreme line for the rock that most of the times aligns with the top of the market, right? By this way, you're gonna be safe, right? So that means just before the failure swing, maybe most of the times actually. So the rock is touching the extreme line, right? So if we check here Starbucks also, the procedure is very simple. You just take it from there, put it on this line, the gray line, and then you have a new inner window. So and then you take the line from here, and you try to find the average extreme line. Right? I'm going to put it somewhere here or maybe a little bit lower, and they touch this one, this one, this one, this one, this, and so on. Of course, you can put another one, which is the over extreme. So, but this one is not happening all the time. So, but still, I have to tell you that on the average extreme lines, the market most probably is reversing. So that's why use the average extreme, which is this one. I'm going to make it a little bit bolder, just to separate it from the all-time extremes, right? So, and then let's check again. So, it's a top. So a top with a small correction, then became a little bit bigger correction. So that's why I believe again for the Starbucks, and most probably the time not to buy anymore. Just wait for a correction, and maybe you can buy later. Or maybe it's going to be a failure swing, right? So that's why what I'm talking about, it's a method, a very simple one. Of course, we can use the bottoms, right? Also, sorry for this. Let's do it. This is Apple. So we can use it like this. So the average bottoms. So actually, we are touching the average bottoms, and actually somewhere here we are at the average bottoms. So then most probably is the bottom for a correction or even for a failure swing to go up. Again, it's not a recommendation. So let's go now for another example. I can show you for those that done the currencies, the same thing. So let's see now what happened here. Price rock. I put it not on the orange, but on the gray area. So I check the parameters, 7, right? So look at what's happening here. So yeah, again, make it blue in order to not to mix it or something. So and always make the central line, I mean the zero line, make it another color except the color of the oscillator and the red lines, right? So then I can use the average tops again, right? So and most probably now we are at the average tops, and this is the euro yen. So see what happened. Actually, we touched the highest ever of the oscillator. So when we reach this top, then came down, bouncing up, and then shows that after the rock is touching the extreme lines or the average extreme lines, whatever, most probably later on will be a failure swing, but this is not the target of this seminar, right? I'm telling you that means don't buy anymore, waiting for the next failure swing that look like that's going to be a failing to go higher, and short as soon as you're breaking this bottom, because now a new trend starts to establish. It's not a downtrend yet, but it's a failure swing, which is very, very important thing, right? So again, let's go for another. Let's say for the dollar yen. This is the dollar yen. Look at the dollar yen. So actually, recently we had the breakout of the high. So and look at this. Definitely, it's at the extremes, average extremes. I mean, this is not the time to buy the dollar yen. So sterling, the opposite. So you see where is the sterling now? If I put the average line, it's gonna be maybe at the over extremes. We touch over extremes, right? So now there is something here that I have to clarify. Is okay. The rock touched the extreme, average extreme, or the over extreme line. So and then bounced up, and now we are here. So I still saying that the rock is at the extremes. So now the rule is that when the rock is touching the extremes and is still not touching the zero, so it's still at the extremes, right? So that's why when it's at this area, even though approach very close to the zero, if it's not touching the zero, to have a close today compared with a close 7 periods ago equal, right? So means that it's still at the extremes. So that's why when I'm asking you, what do you think about the sterling now? We say that most probably it's going to be a correction up, right? So why? Because it's still at the extremes, and actually it's at the over extremes. See? Now, another thing that I want to clarify is that we can change this one into weekly. But now we have to move the line, right? You see? Because now the close for the weeklies, for the weekly chart is different, right? So that's why I always try to find out the recent movement, what is going on, right? So not just because we had this movement in 2008, whatever, you are going to put the line here because maybe we will never have the extreme. So that's why I call it average extreme, right? So look at this now on the weekly also. It's too much. That means what does it mean? Speed limit, right? Or the over extreme. It means that it's too much, right? And if you check it for your instruments that you are trading, you will see that most of the times the bottoms of the oscillator aligns with the bottom of the prices. So that's why now what do we say? We don't say it's gonna reverse. We say most probably will reverse. All right. So in this case, you just don't sell anymore, don't short anymore. Wait to see and bounce up. And if it's gonna be a failure swing, then you go long. So or if it's gonna be down again, breaking the bottom, you short more. Okay. So but now, if you say even if this line is gonna come again around -1 or -2, it's still at the extremes because touched the extremes before and never reset it. Okay. So this is the way that I recommend you to check the market. And going back again to my presentation, so you will see what exactly I'm saying here, right? So let's suppose that we are on this one, right? So if we are in an uptrend or a downtrend, just before the failure swings, so the market shows you that you shouldn't short anymore or you shouldn't go long anymore. Why? Because the rock 7 is touching the extremes up or the extremes down. If later on you have a failure swing, then this failure swing is the best one to short or the best one to go long. The probabilities are 70%, right? That means first the rock is going at the extremes, then it's coming down, creating the failure swing, and then it's breaking down, completing the failure swing. So it means that this is the good one to take for short or to take for long. As soon as the rock just before went up to the extremes, and most probably at this bottom here, so can go again at the average extremes and then bouncing up. So as you will see, testing the rock 7, right? So this is what I have to say today. I'm really willing to answer questions, or you can email us directly to me, or go to our site and just send us an email asking any question that you want. And now I'm willing to answer your question for 5 minutes. Okay. So, yes. All right. All right. So, Bill, can you buy an indicator? All right. That's a very nice question. Actually, Bill asks, can we buy an indicator from MetaStock? According to this theory. So it's a very good question because really I'm trying to convince people, right, that we never trade the oscillator. So why? Because the prices can continue to go higher using the rock, as you saw, is not 100%. So, or even if you are using the whatever. So it's going to be a failure swing still on your time frame. Or if you are on the 10 minutes, it's a failure swing. Or if you are on the hourly, it's a failure swing too, right? So that's why what I'm saying, don't use the oscillator to trade. Actually, of course, we will have more seminars in the future, so stay tuned. And I have another part that we say exactly when do you press the enter to buy and sell. You, of course, is behind this thing, and there is a completion actually of a set of 3 seminars if you want to follow us, Bill. So the next one, where are the recordings? Okay, this is not for me. Does this apply only? Oh, yes, of course. So the question is that if we can apply it on the stocks, definitely. Actually, I show you Apple. So, but I can show you, I don't know, maybe I have here hundreds of examples, right? So let's go first for the stocks. So, and then, okay, let's check this one. I think I have NASDAQ, Dow, Apple, this Starbucks anyway. Starbucks also is at the extremes up now, right? If I zoom it out, you see? Yeah, you can use it anywhere. And not only this, I can use the commodities also. Let me see some examples because maybe some of you are from this part. So look at what's happening with the cocoa, right? At this point, you see, at this last part, so it's going at the extremes. And also we can use it on wheat, right? So that's a case that I was telling you before. It's touching the zero, is not extreme anymore. But let's check something before. So you see the tops here, right? So aligned with, again, the extreme levels, right? So also, let's say corn is touching the zero now, but still you can go for examples, right? So you see that's the average top. This is the average top. This is a little bit lower than the average. Okay, here we have this movement. So if you go and check it, sugar also, let's see sugar. Okay, you see, we are almost at the, you just take the line, go down, and put it at the average tops. You see, that means you cannot miss it, right? So this is the average, and okay, now we can move it a little bit lower if you want, but still, that's the average line, and then you check if this line that you just put on the chart aligns with the tops, or move it a little bit lower or a little bit higher, just to adjust it correctly. You see, you can use it in any single instrument, from stocks to currencies to commodities, bonds, whatever. So is the 7-period rock the only? Okay. No, actually you use more, but for the extreme levels, I found out the last 20 years that I'm using it. Actually, this is created by Prink and Martin Prink. So and I use it when I bought his book first time, just 18-20 years ago. So actually, I stuck with this one, and I was using the 7 for many years, and it is really very accurate. But you can try for your system. You can use 8 or whatever. But 7 was because we had a weekly cycle. But it's not for now the time to explain to you why I'm using the 7. So can you, okay, so is the 7 periods standard? Or okay, I answered also Alfonso's question. So okay, 7 periods again, David. Okay, there is another question again from Alfonso. For the tops, we really use the highest of the area, right? So that means if you are using this spike or if you are using the closing price, right? So to be honest, it's not a big deal, right? So if you're using the closing or the highest, but normally, so all the systems that I checked in my life, that means they're using the tops. But I covered before the spike on the sterling, if you remember. So that's why sometimes if you see that failing to go higher means a double top, and then the break is not that real because came back again, like the sterling that I covered before. Let me show you again. So just use that spike, but still is failing. So let me see the sterling again. Okay, this one. So I said for this one, that was a double top, right? You see, can you see that that was just a movement up, and then during the day closed inside again this kind of range or whatever. So that's why I said, even if you are using the top, just be a little bit more open-minded. That means you see that actually, that means especially if it's coming down, it's breaking here, it's a failure to go higher. I'm going to show you the euro also, if we have time. Oh, actually, it's okay. Right. The answer is that we are using mainly the spikes, but when we have the all-time high and then we cannot break the all-time high, the close is it's okay if you use it. So okay. Yes, Bill. I started with the basic stuff. Unfortunately, I had to do it just to make sure that everybody is with me. But you saw now, that means we advance at the highest level that we can advance. And I'm telling you again, the next webinars will be exactly how to press the enter. That means checking those two things, and then exactly when I'm gonna go long here, right? So, and that's why you have the next webinars, don't miss them. All right, I don't see any other questions, so, okay, we have more about this. Okay, I think we passed already the time, so we have to close here. Thank you very, very much for being with us. Just follow us if you want on our website, and if you have any questions, you can email us, and definitely we will answer you back. But what was my target? The ability to recognize the tops and the bottoms of the market. So, and what I'm saying here is that the top is a failure swing, and just before the rock is topping at the extremes or the average extremes. So thank you very much.